Hey everyone, my name is Addy and welcome to my channel. Today we are going to talk about how to adjust a losing trade. So we have a crude oil trade where we have a strangle going on. I put this on maybe last week, maybe the week before that. It's good to see what to do when things go wrong as well. It's not just about winning the trades and like being happy with it and then not being able to do anything. Today we are going to adjust this strangle and then see if we can get some money back in this one. This trade was up probably 20% and we did not take it off. I wanted to let it run a little bit more and collect a little bit more premium, but right now because the crude oil market has jumped up a little bit, it is at a loss, but obviously it's not out of our budget or anything. It is at a point where we will adjust the trade and look at the trade and then do something about it. So come with me and I'll show you exactly what is going on the platform, and I'll take you through my exact steps of mechanically adjusting the trade and being in the trade throughout the process. Okay, so here's the P&L. This is my simulated trading account because these are big positions. I cannot take these big positions in my live personal account because the account is small. Here I test trades, I put trades on, I win trades, I make videos from here. This is the exact same thing that you will see on the live platform as well. So the CL trade, what is going on here? First of all, quick overlook of the portfolio. We have an Apple trade here. We have a short put here that has come in 60%. So we will take this off. I should quickly just take this one off because this thing has come in quite a bit for us. I think we sold it at $2.50 or something, and today it's trading at $1.15. So we'll just take this one off. That this was a good winner. The other trade that we have is a short call trade in Apple, which is down a little bit. The short call trade is at 275. It's trading at the price is at 257, so we will leave it on. No need to do anything about that trade. So we'll leave that on and then see how that goes. The other one is a Meta Iron Condor that we currently have on. Again, the price moved from last night's earnings. If you look at the close price, it was around 690 and then it opened at 730. That was a big move. Okay, so let's continue our example of going through a losing trade, how to manage, how to fix this trade if you can, how to get it back to break even. Now that it's getting closer to our short strike, what's the plan here? What's plan B? What's plan C? So here's what I'm looking at. I was actually showing you the Meta Iron Condor, which is totally fine right in the middle here, gone up to here at 737. Totally fine. We would probably take off the short put spread here and then just manage the short call, but that's for a different day. Here, the more important thing is to manage the CL trade. Okay, the CL trade is here. The put leg has come in 71%. Perfect. At this point, this is a good number of 380. The calls leg has actually been on the losing side because the market has gone up. So how to manage this trade and how to roll it? One thing we should have done before entering this trade, we should have selected a 45-day cycle. It wasn't available when the market were down, IV was up. So I took a 30, 35, 30-day cycle. And again, that has now come down to 19 days left. And that's why, market, our P&L is moving around too much because there's not enough days left in this expiration cycle. So at that point, if you roll the futures options into the same in the same product, you can roll the whole strangle. You can do 4 legs of rolling in one go. What I mean by that is we are in the March expiration cycle right now, right? This is a CLH26 contract and the options are based off CLH26. So you can see that here. The trade that we are in is in CLH26, which is the March expiration, which is here as well. If you open up this futures bar, you will see which options we are trading. The next one, which is 50 days out, is the TLJ futures contract, which is the April one. The roll that we are thinking about is going from 19 days to expiration to this 47-day cycle, which will be underlying the April cycle. You can see that here. So CLJ 26 right here, which means you are going from an H contract to a J contract, which means you cannot do it in one go. You cannot do a rolling trade here into a different cycle. You can only roll futures options into the same cycle. And by that, what do I mean by that? I can show you that here. If you were to roll this spread, right click, create rolling order, select the first one. It comes up as a diagonal trade. I'll explain that later. But here are the main pieces. What this is doing is it's actually closing this one out. So you can see the +1 sign. It's buying back this spread, which is a CLH26 with strikes 68 and 54, which is our current strike. And then it is selling it the same strikes in the same cycle. And how do I know it's the same cycle? Is because I'm looking at it here, CLH26. Now, if I were to select a different cycle, it would not let me. And that's why you can only roll futures options into the same cycle, but we don't want to roll this into the same cycle. So therefore, what we will do is we will do this in 2 different orders. We will first buy back this spread at 272. So our net P&L is 2,700 negative. Okay, we sold it for 1,600. We're buying it back for 2,700. That's a $1,300 loss. You can see that loss here. If you go into our P&L open, that $1,500 loss is coming up here. Okay, so we sold it for like 1,700, I guess. I'm not sure entirely how much do we sell it for, but we're buying it back for 270. That's a mid price 274. Okay, so I'm going to buy it back at that price 27.40, and I'm paying 454 for the commission. That trade is now closed. Now what we are going going to do is going to sell. This is same as like rolling. If I were to allow a quick roll, I would have done it the same way. But because futures options don't allow you to do that, we have to do it in two different orders. Now we have to select the strikes here. So what I would do, now that the market has gone up so much, look, where is the market trading? It's trading at 65. We started the trade when it was here at 60. It's now trading at 65. So my short call would be a little bit more aggressive than my short put. And what I'm trying to get from that is I will sell it at a 25 delta short call, which will be a 77 strike, because I'm trying to be more aggressive now. When the market has gone up, remember, as a contrarian, when the markets go up, we sell the call side. And that's what the idea here is as well. We are selling the call side more aggressively, and we are selling the put side, you say, moderately, because the market is up. We want to collect more and more premium on the other side, on the call side, so that we can cover our break even, we can cover our loss, and then see how much money we can make here. So 77 is my call strike, and then I have to select my put strike. Okay, so put strike, I will still be around the same delta, around, 18 delta is a good number here, 57. Because if you look at the IV number, IV has popped up and it's come down a little bit. But overall, the put strike is going to be at an 18 delta 57 strike. I'm going back and selecting a 18 delta 57 put strike. So how much am I collecting? I'm collecting $3,000 here. I just took a loss of $1,500 on the other side, and I'm collecting another $3,000. So I have another $1,500 to make. I'm recentering my strikes here and hoping that I can get back to break even. Look at this number. It is 65% of pop. Perfectly fine with that. $3.06. Again, if I want to show you the Greeks, I'm a little short delta here because the market got up so much. I am short delta here, which is coming up this way. Short gamma, obviously, and then theta is the biggest. It will be our biggest collection, and then IV is still popped up, so we are shorting the vol. These are the whole Greeks. We are collecting $3.06, and this is the trade. I'm going to confirm and send. Look, $3,3060 is the net credit that I'm going to collect. The net debit on the other side was $2,700. The net credit here is, so we are still rolling it for a net credit because the IV is popped up. We are still hoping to make break even here, and that's the whole idea. So confirm and send, and let's see how that fills up. If it doesn't fill at 306, for the sake of the trade, I'm just going to go back 1 penny and then sell it at 305 if I can, at mid price 304. Let's try that. There you go, it's filled. So $3,000 collected, $2,700 paid, $3,000 collected, in the hope that we can break even. Now, here's another example of like not every trade is a winning trade. We do get some losing trades, and we should know how to manage the trade. All the other trades are totally fine. The meta trade, I'm going to still sit on it a little bit and then see how the put spread goes, but I will make a video of it when the market comes in a little. One thing I am going to do on the meta trade is I am going to take off the put side of the iron condor. Here's why I don't like the iron condors that much. They get me into this position where I have to manage one side, which I don't like. And that's why I normally take contrarian trades on one side of the market, not both. We still have 50 days left here. And the way the market is going, there was some earnings risk in this one. So in that case, what we are going to do here is take off the put spread, which has come in quite a bit. The put spread max profit was analyze the trade. Let's see. Let me show you the put spread max profit. So I am going to select just the put side. Okay. So the put side max profit was 170. How much has come in? 145 has already come in. So almost max profit has come in on the put side. So I'm going to take this one off and then just manage it as if I'm holding a call spread. And that's the whole idea. I'm just paying $27 debit to get out of the put side here. On the call side, again, we have enough days left. So if needed, we will probably sell another put spread here. But again, with a defined risk trade like this, iron condor on both sides, we don't really like to touch it too much. Again, defined risks are like we go in with a set profit target, we go in with a set loss target, and then that's how we stick to it. But because the market went up, it shot up overnight. Look at the gap up here. It opened up at like 750. It closed at 670, probably 680, opened up at 4730, right? So that's why you get hurt on an iron condor if there is this kind of risk involved. The other thing, the Apple trades are doing well. I've taken up the short at a profit. Short call, I'm going to sit on it again. It's a waiting game in the short call side of Apple. What to do with the meta call spread? It's very close to our market. It is totally fine. We have 50 days left, so we don't really need to do anything here. I'm just going to sit on it. Let's see how that goes. That's it for me. If you like my content, please subscribe to the channel, drop a comment, and I'll hopefully answer. I get all the emails myself, or I answer all the comments myself. So I hope to see you in the next one. Thank you.